Joining me now to discuss is Rebecca Walser, the president of Walser Wealth Management. Rebecca, thank you for being with us today. First, I'd love to just get your thoughts on CPI and the numbers that came out this morning.
Yeah, I mean, I think it was a little bit hotter than anticipated, and that's the 2.9 number. And obviously, core stayed pretty much flat 3.1. And so it's a little bit hotter, and it just gives the chairman of the Fed and the Fed Reserve governors more consternation between that rock and hard place of dealing with this horrible BLS revision that we got the highest on record this week versus, inflation, which is even, the PPI did give us a little bit of good news there, Marley. So, but still, this is a really tough problem for the Fed next week.
So with that said, do you think that the recent jobs data that we've gotten is outweighing any sort of inflationary concerns that we might have in terms of the dual mandate?
I mean, I feel like that Powell kind of foretold that at the Jackson Hole, summit and the speech that he gave there. He definitely made it very clear that he was looking more now back at the labor market. He's had the ability to kind of ignore the labor market for the last, I would say, at least 3.5 years, because it's really been robust and a stalwart. And he's been able to just focus on inflation. And obviously, they were late to the game on that, calling it transitory for a whole year. But at the same time, you can't ease. I mean, the market today, the news today is the reason the market's reacting so positively is because they expect now that the Powell is under more pressure and the Fed is under more pressure to cut and to ease monetary policy. And if we go back to a Fed funds rate again that is so accommodative, that is going to put more pressure on inflation. So other than the PPI data, which came in below expectations and actually dipped by 0.1%, we still expect that the easing cycle will start next week with the FOMC meeting, and yet it's going to put inflationary pressure on this Fed. It is.
So with that rate cut to support the faltering job market and then potentially keeping inflation elevated, do you think that we should expect to see some further acceleration in the inflation number going out the next 6 to 12 months?
I mean, the second we get a 25 bit cut, which the market is already pricing in, Marley, you can see the 10-year dipped this morning below 4%. So, I mean, the market is literally pricing in these cuts already into yields. And so that is going to put pressure on the Fed to keep up with what the market is already doing on the yield front. And yes, they are going to be under pressure. I don't think a 25 bit cut is going to be anywhere near. I know the previous guest said they'll probably cut and look and see. That's true. But the market is absolutely expecting more than just a 25 bit cut. I mean, I think the market at this point is pretty much pricing in 3 cuts for 2025, the September meeting, the October meeting, the December meeting. And then we will be the January, when you look at the actual odds on probabilities on the Fed Watch tool, that's where we get a bifurcation. In January, we get a split where we'll get another 25 cut or we will get a 0 cut. And so that's kind of where the market is, the pause is on the probabilities. But for the most part, everyone has an expectation that we're going to get 3 consecutive cuts here, at least 25 bips.
And is that your expectation as well, Rebecca? Do you think that we get 25 basis points for the next 3 meetings and then we wait and see what the data looks like?
I think that the Fed will not give us a 50 bip cut up front in the September meeting. They could probably do that and maybe pause in October and take a look and see at the data. But I don't think they're going to do that because I think that they believe that that will rock the market and make the market feel like they see more of a problem than they want to foretell to the market. So I think that we will get a 25 bit cut. And I think that they'll say it's data inclusive, but I do expect that they will forecast that they are expecting more cuts as the data warrants. And I think the data is going to warrant it because we have labor problems right now, and inflation again is going to be a problem. But they can come up with another, it won't be transitory, but they can come up with another adjective to describe it, so they can put it on the back burner for a few months while they really focus on the labor market.
And as we focus on the labor market, and the numbers where they are right now, as we come into a seasonally heavy hiring period with the holidays coming, we start to see some of those upticks there. But we know they're seasonal, they're transitory, to use the favorite word there. Is that going to be enough to stabilize, to address inflation? Or because that's transitory, will we still be in this period of uncertainty with the tariff implications with inflation as well?
I mean, that is the question, right? What are they going to do? And the thing is that they know the numbers. They know that the how many of those numbers are seasonal adjusted workers that will come off in January, February when the seasonal ends for the holidays. So I don't think that they're going to be able to say, oh well, it's a fine labor market because the holidays are coming up, and so we're going to again look at just leaving rates the same. This market is really, really, really pricing in now 3 cuts for the end of the year. And it's pushing the Fed to take action. It's interesting because we've seen the Fed be pushed before, like the last couple of times where Powell actually cut rates. We had the rate return right back to what it was before he did the cut. So the market is pricing in risk where the Fed is becoming more, not irrelevant, but they're becoming less relevant than they were before because the market is saying you are going to do this. And they've done that to Powell before, and he's complied.
And so let's talk about tariffs really quick on the inflationary pressures. We know that we're going to likely get this rate cut. It's going to keep inflationary risks elevated because of that. And as we get deeper and deeper into these tariffs and the frameworks being applied, we're going to start to see more of that tariff impact and more of it passed on to the consumer. How is that going to change the scenario? Because spending patterns are going to have to change if those numbers continue to tick upward.
Yeah, it's a great question, Marley. A lot of people just make the assumption that tariffs are inflationary, and that is an incorrect economic assumption because the other side of that economic equation is the demand side. So as tariffs get added to prices and they get passed to the consumer and the corporation's not absorbing it, then that consumer, you're automatically, when you're raising prices, going to knock out some of your consumers, which means some of your demand is going to fall. So what we have to find out is how much of a balance is going to push down demand and how much of the price is going up going to push down demand. So what I'm saying is the equilibrium is not just a higher price. The equilibrium is offset by lower demand. And sometimes we've seen tariffs actually cause deflation because you drive away too many customers and then you have to drop your prices back down. So we have seen in tariffs be deflationary as well. We do not know how it's going to go this time. So we're not sure if it's going to be inflationary or deflationary or combo, and it could have some kind of new equilibrium. And so the Fed is going to have to track that very aggressively. And the fact is, until we get a China deal, until we truly know what the actual Chinese tariffs are going to be into perpetuity, that's really going to be the tell. I mean, all of these other countries are important, but really our number one trading partner is the one that we care most about. And when that policy is finalized and goes into effect, then we'll really have an understanding.
All right, we've talked inflation and we've talked deflation, but we haven't mentioned stagflation. So I do want to get your thoughts here. We're now a full percentage point higher basically than what the Fed wants their target to be, but we've got payroll growth hitting a stall right now. That combination, you could argue, accounts to mild stagflation. Do you have any concerns about stagflation?
Absolutely. I absolutely do, because the economists now have projected that our interest costs are going to be growing at 3 to 4% per year, or our GDP is only growing at 1 to 2%. You can't have your interest outpacing your actual growth of your economy. So we absolutely have concerns of stagflation. And I think that the overall consensus is that it's the AI and the fourth industrial revolution that's the frontier that's going to push us and give us the growth that we need to surpass the interest growth that we're now incurring with $37 trillion of federal debt. So yes, stagflation is absolutely a concern.
Rebecca, it was a pleasure having you on the show today. Thank you for joining us this afternoon. That's Rebecca Walser from Walser Wealth Management.